I was so excited because I'm actually presenting in person today. I hate presenting those WebEx because when I present I hear a little bit of an applause. Yes, because I do a bad job at it, right? I'm looking at a blank screen, and as I'm going through my slides, I'm saying, is anybody actually even listening, or am I on the actual WebEx? So this is great. I see you guys. If you don't like what I'm saying, give me a frown. If you like what I'm saying, give me a smile, and we'll go from there. So if you step back, you think, who are they really attacking? They're attacking the wealthy. No, but you know what? In all honesty, that was an insurance opportunity. That was the biggest insurance opportunity, even more so than when we were touting the CDA was changing back in 2016. This is bigger. This is bigger. Last night, I added number 1, quick budget recap, because I thought, you know what, there might be a couple people in this room that are interested in what we just heard on the budget. So because I just put it together, please don't take pictures of those slides. I didn't pass it by compliance yet. Eric, you're not here, right, Eric? You're presenting. So this is just a general discussion. I want you to be armed with this. And I want to ask, how many people have reached out to their clients post-budget? Good, you're gonna see, good, Alan, excellent, yeah, good. So it's a bad news story budget, right? Bad news story, there's a lot of bad stuff in there. Good news for us in this room, because our clients need us now, right? It's a budget that we are able to build on. So very, very quick hits, okay? You're gonna look at this and say, Frank, you only dealt with a few things. Yes, just a few things that I want to talk about today. So the capital gains inclusion rate, we all know about this in the room. I hope everybody in this room knows about this. On the personal side, we're going from 50% up to 66.7%, meaning that the inclusion rate, if I have a $100,000 capital gain, the taxable portion used to be $50,000. Up until June 24th, we'll still respect 50%. After that, it goes up to 66.7. And on the portion in my brackets, on anything over $250,000 in the year. So you step back and you say, I don't know that many of my clients are going to be affected by this, right? Realistically, how many Canadians are going to be affected by that first line? Well, I know a bunch of Canadians that are going to be affected by that first line, the ones that die. Right? What do we sell? We sell life insurance. So everybody that is in that market are our clients. When you die, you're deemed to have disposed of all the assets you own. When are you going to have the most capital gains in your life? When you die. Who is the white knight to bring the solution? All of us in this room. And you've been doing that. Because it's not as if now that they increased the rates before insurance wasn't a big thing, now all of a sudden it is. But now it's even more important. And then the second thing, corporations and trusts. They're not giving you a $250,000 starting limit. Every dollar in the corporation will have that 66.67% rate. So if you step back, you think, who are they really attacking? They're attacking the wealthy, right? Isn't that the way tax works in a democratic country, right? Democratic, I say very loosely. Increase in the lifetime capital gains exemption. Everybody knows that. That's when we sell our shares of qualified small business corporations, right? That's a good thing. They threw us a bit of a nugget. They say now we're raising it from $1 million all the way up to $1.25 million. Good news. And changes to AMT rules. AMT rules is another, alternative minimum tax. It's another area that doesn't affect many Canadians. When I was practicing tax, very few of my clients actually fit into this AMT calculation. But this is a good news story. They're basically, the charities got up in arms when they changed the rules to make it less favorable for AMT purposes. So now the government's saying, okay, we're going to backtrack and give you a credit of 80% on your charitable donations for AMT purposes. And one thing that I've left out, a lot of you in there that have read the budget thoroughly know that there's this entrepreneurial exemption or entrepreneurial reduction in capital gains tax. I'm not going to go into that in depth. All I'll say is that if you qualify, and everything I've read, people are very skeptical about how many people are going to qualify for their capital gains tax to be part of this Canadian entrepreneurial section, then you're eligible for your capital gains to be at 1/3. But again, I'm not going to touch it because everything I've read, people say we're very confused. All the professionals out there say we're very confused as to who's going to actually be able to use it. So I'm a spreadsheet lover. And this is my quick spreadsheet to say, how does the calculation look? Well, on the left-hand side, it's what we have, what we've lived with, what we've been happy about. And it's funny because my wife and I were just chatting about this, and go figure, my wife's an accountant as well. And she said to me, Frank, you remember when capital gains were included at 75%? My God, so we got a bit of a discount still at 66.7, but I'm not going to be the one that says that. So here's how we calculate effective taxes. Top marginal tax bracket, by the way, is what I'm looking at. So right now, I tell clients, when you die, you're going to pay 27% tax. Because when you die, you're going to be in the top marginal tax bracket, most likely, the kinds of clients that I'm working with. How much is that going to change? Well, and I'm just saying on anything over 250. Top marginal tax bracket, 53%. That's most likely what you'll be in when you die. Inclusion rate is now 66.7, 2/3. And the tax rate is now 35.7%. That's an increase of 9%. Could you imagine if they did that to regular income? Of course, they won't do that to regular income. But when you step back, you say they just raised taxes on capital gains by 33%. This is a lot more powerful, a lot more important than we're making it out to be. I guess it's still early and there's going to be a lot of discussion on this. But again, I love the fact that we're in this business. I hate the fact that this has happened, but this is where we are going to shine with our clients. So I'm going to just give you a few very simple examples. We have a company that did an estate freeze, and I'm keeping it very simple. They froze their shares at 10 million, mom and dad, adult children. I'm not even putting a trust in, I'm just keeping this simple. They've took back all the common shares. Is this very likely? Absolutely. Might not be 10 million, might be 20 million, might be 5 million. Whatever it is, that's the value. Okay. So under the current scenario, under any scenario, what happens when mom and dad die? Well, when mom and dad die, those preferred shares will go over to the children. And I say when mom and dad die. I'm skipping a step here. What happens when dad dies? His shares will roll over to mom. No tax transaction. It's a rollover. When mom dies, shares roll over to they roll over to adult children, and we have a deemed disposition. What's the capital gain? Here's where I do the calculation. Capital gain, now, I've got $10 million of capital gain, 50% inclusion rate. I have a $5 million taxable transaction. My taxes owing are roughly about $2,676,000. 27%, 26.7%. Post June 24th, here's the transaction. Well, I'm going to back out the $250,000 because on the first $250,000, they're giving us a break. And you can see, it really doesn't matter. When we die, with a $10 million capital gain, the $250,000 is meaningless. On $9,750,000 times 2/3, my taxable capital gain is a lot higher. I basically just went up by $1.5 million on this transaction of taxable income. My tax rate is 53%, the top marginal. Taxes owing, $3,481,000. And by the way, I'll also capture the tax on the first $250,000 that I left out of here. So when I add these two numbers up, I'm at $3,550,000. So the gentleman that raised their hand and said he called clients, you have a sale, an opportunity. If you've already sold this insurance policy, fantastic. Glad that you did that because You basically planned for what the environment that was at hand at the moment, but now you have the opportunity to sell another $871,000 of insurance. Because these people are exposed. Even though they did the right estate and tax planning, they're exposed by $871,000. Am I using numbers that are too big? Absolutely not. This is the kind of market that I'm working on, clients with yourselves. This is the market that we're in the high net worth area. How do we, and I put this little joke here, how do we provide an extra $871,000 of cash on death? Nobody better get that wrong. We provide it with life insurance, right? And guess what? A lot of us sell a par contract. No disrespect to UL, but if we sold a par contract, here's where we might be able to say, hey, listen, maybe you don't need any more insurance. Because remember I told you that par contract is growing? Yeah, you know what? Thankfully, I sold you a solution that was extremely conservative. I have buffer there, and now you have perhaps a death benefit that was going to be higher than the tax.
So, but if we look at a state freeze, I'm assuming mom and dad are still both alive.
When they do the freeze, yeah.
When they do the freeze, but the tax isn't going then?
No, absolutely not. I'm glad you mentioned that. So I'm going to give you Estate Freeze 101. Estate Freeze 101 is mom and dad value this company. Mom and dad are 65 and the kids are 35, okay? Mom and dad do a valuation of this company and it's $10 million. And their good accountant says, it's 10 million. What do you think it's going to be worth 20 years from now? Maybe 20 to 30 million, they say. Okay, well, why don't we freeze the tax liability? Freeze the liability, not pay tax on it, freeze it. How do we freeze it? Mom and dad give in their common shares and they take back preferred shares worth the same value. So if you give back common shares that were worth 10 million, now the free shares are going to be worth 10 million. The adjusted cost base, when we capitalize a company, when we start a company, how much money do we capitalize with? $100, right? Zero, $100. So the ACB is zero. We take on the ACB of the common shares that we traded in. So that's a pending tax liability, Dave. That's a pending. That's why we froze. Now, what's those children's common shares worth immediately after the freeze? $1. If the company was worth 10 million and we just froze, then the common shares are worth $1, which makes it very easy for us to sell shares to our kids. Now they're in. Anything that happens in this company, if the kids want to sell a year from now and they get 11 million, first 10 million goes to mom and dad because they own preferred shares. Call it debt if you want. Preferred shares are almost like debt. We're all good on this? I know I went through it quick, but I know you were in here for a different deliverable and I changed on the fly. And by the way, if you take me on a case, a lot of people would say that I'm pretty good at changing on the fly. And what I mean by changing on the fly is clients will throw a lot of stuff at us. And I always tell clients the best thing for me to bring when I go into a meeting, Armin knows this, and so many people that I work with, I bring in a blank piece of paper and a pen. Now, sometimes I don't have a pen. You better know that about me. Bring an extra pen. Why do I bring a blank piece of paper? Why don't I bring a presentation? Why don't I bring a deliverable on the first meeting? Get this. I'm sorry, I bounce all over the place. I was asked to go in on a meeting to basically meet the client for the first time and show them an idea on a $10 million sale. This happened last week. It wasn't like a year ago or 2 years ago. And I said to the advisor, I'm not bringing a presentation the first time I meet the client. How can I bring a presentation the first time I meet the client when I don't know him? I don't know anything about him. You told me his name. I know he's a very respectable person. I've looked him up and he's worth a lot. First thing the client says to me, okay, we're ready for your presentation. CAs were there. His trusted partner was there. And I looked at him and I said, sir, I don't have a presentation. And he says, so why are we here? I said, so that I could work on a presentation and I need to know you before I do anything. I said, the last thing I was going to do is bring you a product presentation, a canned approach. I said, wouldn't it be better if I get to know you today and then bring you something that's of validity to you? He says, you know what, Frank, I like that. Thank you. Always remember, we need to know the client before we could recommend anything. I'm going to pick up my pace a little bit. Do we see this often in our business? All the time. Cottage, rental property. I deal a lot with people that have rental properties and they know the impact that they're going to have when they die. So how does it look when we die? Well, when we die, all of our assets go over to our children. I don't really care about the tax on principal residence because they haven't taxed it yet. Would anybody be surprised if they, in a future budget, tax principal residence? I wouldn't be surprised. Maybe not 100% of the capital gain on it, but hey, I wouldn't shed tears if I'm the government. This is not Frank speaking, but I wouldn't shed tears for the recipient of an asset like this having to pay a little bit of tax. Again, not me, but you think about the government's perspective. So we're not going to pay tax on the principal residence, and I'm assuming that the gain here is bigger than the gain on the cottage. But am I off on saying that the cottage that was purchased who knows when for $500,000 is worth $2.5 million? I don't think that that's an outrageous assumption. Well, let's see how that gets changed in terms of taxes. Under the current approach, I would owe taxes, basically my capital gain is $2 million, right? I'm going very quick through this, I'm sorry, but $500,000 of cost base versus $2.5 million tells me that my capital gain is $2 million. Taxable capital gain is $1 million. Tax owing is $535,000. Oh, guess what, Mr. Owner, Mrs. Owner? After June 24th, you're going to have a new liability. So we sold you enough to cover this. You're going to owe actually $772,000. Simple examples, real examples that are going to impact your clients. And the last one, I think I went very, very technical on this, and just in the interest of time, I might just skip over this. I'm going to ask the audience if you really care for me to go in depth. I'm just checking. I'm not checking texts. I'm checking time. Do you want me to explain how capital gains in a corporation work, or would you rather? Unanimous? Okay. People don't really understand this. So, capital dividend account, we know that it comes about when we have a life insurance policy, right? A death benefit received in a corporation gives rise to CDA, proceeds minus ACB. I love it. I love it when I see on financial statements that there was a sale of a building. I love that. Because when you sell an asset in a corporation, you get the pleasure of working with a capital dividend account. What the law says is that when we have a capital gain in our corporation, the portion that's not taxable creates a CDA. Did you guys know that? Did you know that when we sell an asset in our corporation and we have a capital gain, the non-taxable portion goes into our capital dividend account? Why do I love it? Because clients love that effect of receiving their capital dividends because of the sale of land or the sale of stocks and them experiencing the CDA. Then for us to talk about life insurance, it's so easy. I keep saying, remember how you collected that tax-free money from the sale of your building, from the sale of your land? That's pretty much how the life insurance works. You just have to die to get it. So, sale of public company shares. Let's assume that we have $1 million capital gain. There's a reason I don't give ACB. I don't want to confuse here. But I'm just assuming that we were gifted these shares for zero. And there's a reason why I do this. I want to make it as easy as possible. So I sold my stock portfolio and I got $1 million for it. My capital gain or my cost basis was zero. The taxable portion right now is $500,000. So in the corporation, I have a taxable portion of $500,000. And then the other portion goes to the capital dividend account, $500,000. So what's the rate of tax on the taxable portion? The rate of tax on the taxable portion is the passive income tax rate. All of the carriers out there, I see an experienced person that is amazed at this. All the carriers out there talk about interest income. Interest income in your corporation is taxed at the passive income tax rate of 50.17%. Guess what? The non-taxable portion of the capital gain is also taxed at the passive income tax rate. So I now have to pay tax on half of that capital gain. So I'm paying tax at 50%. So $250,000 is the taxable portion. And now here's this thing, I don't want to get too complicated, but RDTOH, refundable dividend tax on hand. What this says is it says, hey, if you pay tax of $250,000, this is going to be refunded to you when you have to take the money out and you pay dividend tax. We'll refund you this tax when you pay dividend tax personally. So, how much do we end up with? $1 million proceeds minus the corporate tax. I have $749,000 left to distribute. Well, out of that $749,000, I elect the first $500,000 to be a capital dividend. I take a taxable dividend of $249,000, and I take the refundable dividend tax credit, the refundable dividend tax on hand. So the proceeds going out to me as a shareholder, right, net cash to shareholder, what I get is $500 plus $249 plus the refundable dividend tax on hand. How much tax do I pay on all this transaction? I pay tax on only these two amounts. $249 plus the $153 tells me I have to pay dividend tax. So when I reconcile what I get as a shareholder, this is very important. When I reconcile what do I get as a shareholder after I've incurred a capital gain in my corporation, I've got roughly $713,000. Look at this, 29%. Isn't that very close to the 27% tax rate that we had before 2024, June 2024? Do you think that that just happened by chance? No, that's called integration, tax integration, where we should be indifferent towards earning something in the corporation versus earning it personally. Now, post June 2024, I'm going to go through this a little bit quicker now. All of a sudden, the portion going to the CDA is only a third. Well, that sucks, because I love the amount going to the CDA. So all of a sudden, the portion going into the CDA is only a third. Tax is now going to be much higher, because I got to pay tax on the 667. So I got $334,000 of tax, and I've got an RDTOH balance that's going to come back to me. Net proceeds to the corp, $1 million minus the corporate tax, so I have $665,000 in the corp. How much does the shareholder get? Shareholder gets only $333,000 of capital dividend, which is non-taxable. The taxable dividend is going to be the remainder, and it's going to be the $204,000 of RDTOH. So dividend tax is this times 47% top marginal tax bracket. Look at my new after-tax rate, 38%. If I go back a couple slides, what's the new capital gains tax rate? 36%. So it's all designed, it's all manufactured. They got some pretty smart people figuring out how to take our money. And here's what I put on the side. Corporate equals 38% on all capital gains. In the corporation, they don't give you this little $250,000 of exemption, because $250,000 is a lot in the corporation of capital gains. Every dollar of capital gain in the corporation is going to yield you a net flow-through rate of 38%. So how many times do we show a corporate estate transfer where the individual says, yeah, but you're going up against interest income, and interest income is taxed the most heavy in a corporation? Well, guess what? Capital gains is not doing much better anymore. At 38%, we now have a high rate of tax. So just keep that in mind. I think it's just very important for us to know this stuff when we're dealing with our clients. And I think the best advice before I move on to the presentation, this wasn't even the presentation yet, I'm sorry. But my best advice is do not bother accountants these next 2 weeks. If you want to be their friends, April 30th is around the corner, and they'll have at least a month to breathe after April 30th. And be very cautious about how you approach this. I don't think clients like you coming at them at 100 miles an hour. I think if it was me, I'd be very subtle to say, hey, we need to start talking about the budget. Maybe we should incorporate your accountant as well. I got my thoughts about incorporating accountants. We incorporate accountants at the right time, but just be subtle about this. Nobody likes to know that all of a sudden their tax bill went up $236,000, or all of a sudden their tax bill went up almost $1 million. Be subtle about it, and if you think I could be of an assistance, please, by all means, I'd love to help.